Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. Apologies for my voice, is a little bit all over the place today. You know, when you have children and children that go to school, every single month one of them is sick, and then what do? They pass it on to you. That's exactly what happens to me. I think my immune system is terrible. But Alhamdulillah, I'm good. It's just the voice is just a little bit too much right now. But yeah, today's video we are looking at two different companies. One, some of you have actually asked me recently. I kind of forgotten to add it to the last video, so apologies. If you're watching, I think one of the brothers asked me to look into this company, and that is MSCI. And the other company that we're looking at today is Accenture. Those two companies are companies that normally most people in probably investment kind of ignore them because they probably don't know what they do. They're not as exciting as the Teslas and so on. But these companies, I do believe, have a great business, so we just need to look at their financials and to see if they actually will be a good addition to any of your portfolios. And I'm just going to give you the overview. But before we do that, we're going to talk about a couple of things. First of all, like the video please, because that really genuinely helps. Second thing is we're going to talk about the earnings reports that's been happening in the last 48 hours. And yeah, it doesn't look great for Amazon. It looks really ugly. I mean, it wasn't even that bad. Is the guidance that were a little bit lower, and they missed revenue, and this is what's happened. So after hours was actually down almost to 20%. Right now it's only down about 13%. So not really bad at all. But yeah, it had to come back to earth. Again, when you have a PE that's almost 100, I think that's probably inevitable. When growth is no longer there, then these companies have to pay price, right? So yeah, so Amazon is not doing as well, and Apple is actually done all right. I mean, it's not down at all. I don't think it is actually down at all. It was up when I checked last time. Let's go and check it. Yeah, so it's up a little bit, just a little below 1%. But because of they haven't actually missed anything. They beat both top line, bottom line. Everything looks fine. The only thing that I would say is this is one of the things they do. They have not given their official guidance, and for that reason, basically, if they had given something and said, you know what, in whatever in the next quarter, this is what's going to happen, they probably would have tanked if that was not a positive one. But since 2020, apparently they haven't actually given any official guidance. So we'll see what happens with going forward. But today they are flat, but they look all right. Intel was another company that actually reported, and it looks okay. It's not actually that bad at all. They actually beat their EPS, but their top line and bottom line. But the issue is they are cutting costs. Okay, they are really massively cutting costs. I think they're cutting almost 10 billion in the next 2 years or something. So yeah, for that reason, it is actually up. I think almost 5%. But other than that, yeah. So final company I'm going to talk about is Unilever. Unilever actually reported. It was a good report generally. I've actually gone through their presentations. There's nothing to alarming for me anyway. But one of the things they've actually talked about is the fact that they were able to increase prices and genuinely increase their prices on every single product they own, which is these companies have pricing power generally, especially like the things like the personal care and home care, nutrition and all that stuff. Genuinely, even ice cream, some of the ice cream products actually they increase the price. So they do have a pricing power, and that's helped the company massively. So they had a good quarter. They beat top line, bottom line. Guidance was actually good as well. But yeah, so let's see how that one goes. So nothing too alarming so far for the companies that I own in my portfolio. So like I said, I'm going to check these two companies. But before we do that, some of you asked me questions regarding whether the S&P 500 basically to compare the S&P 500 against some of the Islamic ETFs that we own in our portfolios. Okay, so that's what I want to show you right now. So what you see here right now is the iShares Islamic ETF, so the World Islamic ETF, and then the US version. So these two. So I used to have both of them. Right now I only own the World. I've got rid of the US version, and then the S&P 500. As you can see, okay, a year to date, okay, the S&P 500 is down 20%, right? And the US version is actually up almost 3%. Okay, I think that is ISUS or whatever it's called, right? And then the world one is actually just down 1%. So these companies are holding it really well. But you know why they are doing that? Is because of this. So the energy index, the Vanguard Energy Index, right? When you look at it year to date, it's up 55%. Quite a bit of the companies in there are energy related companies. And for that reason, it is actually basically down and up quite a bit. Otherwise, it would be down just like everything else, okay? Because the energy sector is the only energy basically sector that is actually doing really well and has done a year to date basically really good. Even if when you look at it for 1 year, okay, it's 52%. But when you look at the last 5 years, okay, about 32%. So at some point, okay, this year basically is doing about 55% from, and actually went down from July highs. So yeah, that's one of the reasons why I think these ETFs are doing really well, okay? Otherwise, they would have, I don't think they would have, okay? So, yeah, the US version and both of them have quite a few companies in the energy sector, and that's helped a lot. Obviously, the S&P 500 companies that are in the energy, obviously they are in the energy as well, but you got 500 companies there. So that's probably why it kind of balances out. So let's add a couple of more companies to see ETF, sorry. Well, let's check with Wahid, okay? And then we will also check the SPUS version. Okay, these two ETFs as well. Basically, they are very similar to the S&P 500 because when you look at their top 10 companies, majority of them are the top 10 companies in the S&P 500. And for that reason, they literally mirror when you look at these two. Look at this, the last three there, in terms of the graph. Okay, as you can see, they're literally doing exactly more or less the same thing. Whereas the top two, okay, have done their own little thing going on. So the top two are the S&P, the two Halal ETFs, the iShares, sorry, and then the other three are literally mirroring each other. So there you have it. Okay, if you're interested in basically buying in some of these ETFs, obviously you have to take the risk of, if, for example, the oil companies do not do as well as they should do in the next couple of years, obviously this is not going to work. This is going to come down again. So you have to take those risks. And this is why I always say to you guys, look at the ETFs that you're buying and look at the weightings on certain sectors and certain stocks and so on, because it really helps. Okay, right now it's helping these ETFs because they have a lot of oil companies. The oil company tanks, then what happens? Okay, so that's the thing that you need to worry about. So yeah, there you have it, those two ETFs and obviously the other two, and as well as against the S&P 500. They're doing all right. And I think if you are new to investing and you generally can't be bothered to pick stocks or learn about it, probably you'll be better off looking into these ETFs and then just basically put some money into it and just kind of forget about it. And buy every single month, okay? Just buy a little bit of these companies every single month and completely forget about it. So the two companies that we're looking at today, the first one is MSCI. That's basically a company that provides benchmark to asset managers and asset managers and asset owners. This basically helps a lot. You know, a lot of the ETFs, the benchmark for the ETFs is basically the index that this company has created. So they are in the financial analytical side of things. They provide a lot of things, to be honest with you. So basically they provide portfolio management, risk management, analytical software to asset managers and asset owners and so on. So it's not a huge company, but they're based on what they do, how much actually influence that they have on the indexes is actually quite a big company, right? It's financial services, $455 per share, EPS of $10, market cap of only $36 billion. It has a wide economic moat and is actually beta. That's not really bad. When you look at the PE, when you look at price to free cash flow, you're like, okay, this is ridiculous, right? 43 to 42, right? And then you look at the annual dividend yield of just 1%, 5-year growth rate of 29%, dividend growth streak of 7 years, payout ratio 37%, and dividend safety 61%. Free cash flow here, we're looking about just less than 1 billion. Ideally, I like companies that have excellent free cash flow. This is okay to cover the dividends, but they can't really do anything else. They can't pay off debt and things like that with this money. So yeah, you have to really be careful with that. Profit margin 36%. In terms of operating margins, we're looking at 52%. Return on equity, they have a negative equity right there. Total return, we're looking about 10 for the last 10 years, 32%, almost 33%. So that's probably why people actually saying, basically betting on, or the fact that this is trading a higher multiple is because of those types of returns. Current ratio is just above 1, so they've got enough assets to cover their liabilities. In terms of the next basically 5 years, earnings are expected, earnings are expected to grow about 13%. Fair valued according to Simply Wall Street is 423, so it's actually a little bit overvalued at the moment. Fair value according to Morningstar is 370, and that's 22% premium. Okay, target for the tip rank is 501. You've got about 10% upside on that one, and they are saying it's definitely a moderate buy. For me, by looking at the PE, by looking at basically the fact that it seems a little bit overvalued, you'll probably will be better off waiting, maybe just to stock to come down, maybe at least in below 400s if you want to basically invest it. And to be honest with you, I'm sure in the last few months it gone down maybe to those levels, so it's not basically something that I'm just saying completely is not doable. Okay, you might see that and you might get the opportunity. Right, so in terms of total revenue in the last 5 years, we're looking at 1.4 billion to 1.5 to 1.7 to 2 and 2.2. So it really is increasing slowly, which is good. Okay, and then you look into the cost of the revenue, which is absolutely amazing, because these companies, they just have those software and whatever, they don't really much innovating anymore. I don't know. Maybe they don't have that much of overheads. I have no idea, but the cost of that revenue is actually not that bad at all, because they taken from basically 1.4, they took 1.1 billion and only spent 287 million. That's ridiculous. But yeah, and it actually is it's growing every single year. So right now they're basically looking about 1.8 million of gross profit. EBITDA, we're looking at net income, so we're looking about, it's growing. So so after they pay taxes and all of that stuff, then obviously they've got from 500 million to right now 850 million. So it's actually heading the right directions as well. Same thing for the EBITDA, is actually growing. Free cash flow from 563 million to right now 990 million. So yeah, it is definitely heading the right directions. And remember, it's only $36 billion company. And when it comes to shares outstanding, it's actually declining, which is very nice to see. Unlike SPG or S&P Global that we looked at yesterday, where it was going up. So the first company, or the second company that we're going to look at today is Accenture. Oh, actually, before I forget, okay, let's go up here. So when it comes to their business activities, we're looking about 99.93. We're looking about 14% in terms of interest-bearing debt. And when it comes to securities, we're looking about 2%, okay, or 2.5%. So that's that one. Right, let's go and look at Accenture. Accenture is one of those companies that provides consulting strategies and so on. Basically, they deal with a lot of companies in the communication, media, technologies. They go to these companies and they actually set up IT technologies and so on. They kind of help them maintain their IT systems and so on. Really great company, especially they are when it comes to consulting. Basically, they are the number one company, basically. And I remember when I was university, I did what's called sandwich year, and I applied to this company. In fact, they offered me a position, but basically where they were based was quite far, and they were expecting someone who can travel. So basically, this was as a student in university. We basically applied to loads of companies, and I did an interview and I got the job, and then they said to me, do you know what, you're going to have to travel doing this. I'm like, listen, I just want something I can put on my CV. I don't want to travel. I didn't know how big the company was. I was stupid, but alhamdulillah, it worked out for me anyway. I ended up with another great company as well, so alhamdulillah. So anyway, the company is currently trading $278 per share, EPS of 10.71, market cap of $177 billion. I genuinely didn't think it was that big of a company, but it is. Wide economic moat right now, beta is slightly higher than the market. PE is 26, which means it's a little bit pricey, but I have not seen this company trade lower than that for a very long time. Price to free cash flow is about 20, so that tells me it's okay. The sector, we're looking at about 24.52 right now, so it's not much that much off, but 26 seems a bit higher in comparison to what's happening in the general markets right now. Annual dividend 1.6, 5-year growth rate 10%. Dividend growth is about 17 years of pay, increasing that dividend. Payout ratio only 37, so which is quite nice. And then safety of 92%. They have $8.8 billion in the bank, which is this seems a lot more healthier business than the one that we just looked at because of that free cash flow, especially right now when things are not going the right directions. Especially you've seen what's happening to all these companies. You miss something and then all of a sudden people will start selling the stock, whatever. If you've got really like a good balance sheet, okay, generally I think you will survive in this kind of climate. Profit margin 11%, operating margin 15%, return on equity 32%, total return in the last 10 years we're looking about 16%, current ratio above 1, which is really good. And the next 5 years we're looking about 12.4 in terms of earnings growth. Current price, like we said, 278. Fair value 356, so that's basically undervalued about 21% according to Simply Wall Street. Fair value 258 according to Morningstar is fairly valued right now, and the tip ranks price target for the next 12 months is 320. That's 14% upside, and according to them it's actually strong buy. And by looking at these metrics, I think it is okay. I would love to see it be below 250 just to be on the mark. Remember, we always said in this channel, always have a margin of safety, because some great companies, even though financials look amazing, right, financials, sometimes you need that safety. Okay, you need that margin of safety. If you have margin of safety and you bought a stock that was supposed to be, I don't know, £200, but you bought it for 150, that gives you a margin of safety. So just in case you get it wrong, at least you have that margin of safety in place. Okay, and finally, looking at their total revenue from 43 billion to 44 to 50 to 61 billion dollars. That's a massive jump. They must have acquired another company in the process, and probably that's what's helped them, because to jump from 50 billion to 61 billion and a half, that's a lot of money. That's a massive jump. So it will be interesting to find out. I can see if there was only 1 billion there and then about 6 billion there, but then 10 billion. So they must have acquired another company and then basically integrated into their business, and then they now getting the reward for it. I don't know, or maybe it was genuine. I have no idea. So the cost of that revenue, you can see it there, but the gross is actually not bad at all. 13 to right now 19.7. Net income from 4.7 to now 6.8, and then EBITDA of 7.1 to right now 10.1. And then finally, when you look at the free cash flow, 6 billion to right now $8.8 billion. And they are buying back their own shares. So this year, they haven't actually done that, but they have kept it as it was. But you can see they're buying back those shares as well. Finally, let's look at from Sharia compliance side of it is 100% when it comes to business activity, 1.9, 3.6. That tells me this company has a clean balance sheet, like genuinely. This is perfect. This is what you want to see. Okay, so because remember, these companies do not have any debt. They're not taking any. Basically, they've got enough current assets to actually cover their liabilities and things like that. Yeah, ideally, I would love to see this stock be below 250. If it was below 250, I think I would really be interested. I do love technology companies, and I do own so many of them. But yeah, this is probably one of the companies I would love to add to, because they don't just basically, they are a very innovative company and they work with a lot of companies out there. So for that reason, and the fact that they have got $177 billion market cap, that is absolutely brilliant. Right, if you enjoy this type of videos, please like the videos. That's all I ask. Okay, I'm not asking you to, I don't know, buy a course or anything like that. It's just I'm just sharing my journey with you guys. I'm listening to you guys as well, just to kind of help you guys out there. I've had a little bit of time this week, so inshallah, and hopefully my voice will be better in the next couple of days. And then I've got a couple of more videos I plan to do before I go back to that mad workplace, and then I might be too busy to do a lot more videos. But yeah, there you have it. In fact, one of the final thing I want to say is, if you are genuinely, and I think I said this already, but if you are genuinely new to stock markets, right, stick with the ETFs for now while you learn on the job. Okay, so just do your research and find out a bit more, read a couple of books, and then in the meantime just invest in some of the halal ETFs that you can find, especially looking at the iShare ones or halal or whatever, whichever you're comfortable with. Remember, I'm not giving you financial advice, it's just my opinion. This is what I would have done if I was starting and didn't have a lot of time. I'll be honest with you, the fact that I'm enjoying what I'm doing, that's why I actually have all these companies in my portfolio. It's hard to keep up with it. I promise you, it is really not that easy. And I don't think I could do this for a long term. But inshallah, we'll see how it goes. That's the only ETF I have. I haven't added to it in lately. So possibly in the next couple of days, I might actually add a couple of more shares and just to kind of increase it maybe to about £1,000 worth of whatever. I don't know. In the long run, I might sell some of these stocks and just buy more ETFs just to kind of chill and not to worry about what's happening, considering the prices of these ETFs, especially the iShare ones, actually come down quite a bit. Okay, 0.30 from I think 0.6 or whatever it was. That's half what it used to be. For that reason, I think we might be better off buying this if you are new to the stock market and you're still not sure what to do, because you get a basket of companies, right? Watch the videos that I've done on these ETFs if you're really interested. Anyway, let me stop talking and rest my voice. Have a wonderful day, wonderful weekend, inshallah. Assalamu Alaikum.